Ben Reppond. Welcome to my YouTube broadcast. Today is February 15, 2023. Let's get into the market, the charts. Let's start with the dashboard. I've got two of them to show you. The first one is showing the major indexes, the 4 U.S. indexes, the 2 foreign indexes, and then the long-term government bonds. You can see on the far right side that with the green dots or red dots, this shows that those indexes are above green dot, their moving average, or they are below their moving average, the 20, 50, 100, and 200-day moving averages going from left to right. There are 4 red dots. The rest are green. So this is more of a bullish sign, but for this past week, you can see in the very center, there is a weekly percentage change for each of these, and then next to that, to the right, in the center, is the year-to-date. So you can see that all of them are positive year-to-date, and all of them are negative for this past week. The U.S. indexes are the Dow, DIA, the S&P 500, SPY, the Russell 2000 Small Cap Index, IWM, and the NASDAQ 100 Index, QQQ. The foreign indexes are EEM for the emerging markets and EFA for the developed markets, and TLT for the long-term government bond. So slightly negative for this past week, but in general, the intermediate, I'll call it the intermediate term trend, is positive. When the S&P, you take the S&P and you break it apart into its 11 sectors, you can also see the same thing. You can see the green dots or the red dots above or below their individual moving averages. And there are 8 red dots out of a potential 44. That's slightly higher on the red than last week. And you can see in those 2 center columns the same thing, the change for this last week and the change for the year. Most of them, all except energy, were negative this last week. Energy was positive. And for the year, you can see all of them were positive except for consumer staples and healthcare. So, which were, by the way, the best ones, or at least down the least last year. So everything has kind of flipped around for this year. But again, generally, I would say this is a positive tone, especially for most of the indexes, or excuse me, most of the sectors. I'm going to show you the chart on the S&P 500. This is SPY. It's a 1-year chart. Excuse me, it's a 14-month chart. I expanded it out to 14 months so I could show you the length of the direction of the S&P 500. So it goes from a high 14 months ago down to where it is now. So the black line indicates a longer-term trend down, and then I put the red arrow at the bottom because it shows from October to present, generally speaking, there's some ups and downs, but generally speaking, from a bottom in October until today, generally a short-term rise in the S&P 500. This last week, you can see from the tick down that it was a negative week. I thought I would expand this from not just a 14-month chart, but to a 14-year chart. So I went back to 2009 to present to show the S&P 500, but I did it on a monthly basis. So every move in this line is the line, there's a moving average, and you can see that's underneath it. But above this, the line that goes up and down, you can see that this is the direction since 2009. The market has, generally speaking, gone up. When we got to 2021, you can see the degree to which it was extended or even hyperextended above its moving average, setting in place the direction that in 2022 that had to revert to the mean and come back down to probably even some kind of a trend line. But you can see the magnitude of the drop in 2022 and where we are now relative to the 20-period moving average. This is, again, a 14-month chart showing the relative strength of value stocks in the S&P 500 versus growth stocks. If it is going in a downward direction, this favors value stocks. If it goes in an upward direction, this favors growth stocks. So you can see for this entire 14-month period of time, the general direction is down, and that means that growth stocks are in favor. At the very end of the chart, you can see that growth is starting to do a little better than value, but short-term growth is in favor, but longer term, you would say that value has been in favor for about a 14-month period. That's not surprising for a bear market to have growth stocks fall further than value stocks. Value stocks don't necessarily hold their value, but they decline less in a falling market. When I compare small cap stocks, the IWM is the ETF, to large cap stocks, meaning the S&P 500, you can see from a relative strength standpoint, during that period of time, if it goes up, that favors small cap. If it goes down, it favors large cap, relative to each other. They may be both declining or they may both be rising, but which one is rising the most or falling the most? So you can see at the very end, there is a little tick down that shows that the S&P is stronger than small cap, but that and that over this long period of time, that the S&P is stronger than small cap. There are certainly in the past year, they have gone back and forth, not really having a specific direction. So I thought we just expanded for this 24-month period so that you could see that in general, large cap was in favor over small cap. The long-term government bond, this is not a relative chart, this is an absolute chart showing the long-term government bond ETF, TLT, and the direction that it is over this 32-month period of time. So then two periods of decline, one back, the beginning 32 months ago, went down for a while. The second one went down during the past since late 2021 until today, and it is still in a downward direction. So what this means is that interest rates are going up and the price of bonds are going down. And that seems to be the current trend until interest rates stabilize or start to turn the other way. I would imagine this chart would probably start to be more in favor of bonds once there's even a degree of stability of interest rates. The dollar has been, for the past few months, has been in a period of decline, but for the last couple of weeks has risen some. So you can see it's gone way up, and then it's come down some, and now at the very end it's starting to go back up again. We'll see if that lasts. It seems like the black arrow indicates that the short-term direction is in a downward direction. Gold has been rallying for the past few months, and it is stabilized this past week. It's down a little bit, but generally it has been in an upward direction for the past few months. Silver has the same thing, but it has been weaker in the past several weeks. So relative to gold, now I'm going to show you the relative chart. Relative to gold, silver has declined or has gone up less than gold or has declined more than gold. So they both go up and down on this chart, but it is interesting that in a period when it's rising, that silver would underperform gold. But silver is more volatile, but right now I'd say gold is the stronger of the two metals. Bitcoin, you can see the long-term direction of Bitcoin has been down. You can see since the beginning of the year, Bitcoin rose quite a bit at the bottom. That's about a 30% rise, by the way. And then this month has been declining, so including the last couple of weeks. So this is a 14-month chart. Volatility, because of what I showed you earlier, you could see that the indexes all were negative for 2023, or for this past week, and that a number of the sectors were negative. And so you can see what has happened is that volatility has gone up at the very end of the chart. I put the black line in to show the level of, if it's below that, generally that speaks to favorable equity conditions. And if it's above 2024, particularly if it's rising up above, above 24, if it's rising from underneath and going above it, that's generally indicating a significant rise in volatility. Asbury Research went from last week, where there were 6 metrics measuring market conditions, and now there are 4 and 2 that are negative. So again, speaking to last week being more negative, but generally it's not turning that red. So I'd say, generally speaking, it's still in a positive mode until we see otherwise. Right now, I don't see right in front of us that there is a risk, negative risk. But as I said yesterday in the video, during 2023, the first half of 2023, there is likely to be a downturn according to a lot of the economists. But right now, we have not experienced that. So I would not interpret this past week as moving in that direction. This is a from Asbury Research. This is a cross-asset relative performance chart showing which assets are stronger than the others. The ones I focus on are the ones that include the weekly, the monthly, and the quarterly green boxes. That would show enough strength in all 3 time periods. And there are 2 that meet that test. One is that the U.S. is stronger than the emerging markets in all 3 time periods, and that in the bond area, short-term bonds are stronger than long-term bonds. We get to the U.S. versus the world. It has been months, quite a while, since the U.S. has had a single green box. It is not enough stronger to get a green box in the weekly, monthly, or quarterly. This chart shows that Chile and Italy are the only 2 countries that are stronger than the U.S. in all 3 time periods. The U.S. is stronger in some, but barely enough that it's not even enough to get a green box. When I just chose Italy because it was it made my point the best. So you can see it's a relative chart showing the U.S. SPY relative to Italy, which is the ETF is EWI, put on a relative strength chart. You can see that, and Italy being the numerator, U.S. being the denominator. So you can see that as it rises, that's going to favor Italy. When it falls, that's going to favor the U.S. So the degree to which, since last August, the degree to which Italy has outperformed from a general market perspective versus the S&P 500, pretty pronounced. I thought that was interesting. Gold and silver. The gold prices fell about 3% last week. Silver 1.7, both negative and compared to the week before. You know that I don't have a TV. I got rid of my TVs, and you can see the excitement that people have when they finally stop watching CNBC. I've got nothing against CNBC. I show you a lot of material, but I like to access it on the internet when I want to see it. I personally don't like to have a TV blaring. And so it's just a little, it helps me in my frame of mind to not be glued to that. And I would admit that I would probably watch more of it than I should if I had a TV. But sometimes they show things that aren't terribly the most encouraging. So you can see why this guy's happy. If you have comments or questions, leave them in the comment section below, and I will answer them. Thank you for watching.